The paradox sits quietly on the Pacific coast. California is richer than most countries, yet it keeps discovering holes where money should be. Not stolen. Not burned. Simply gone. $92 billion didn't vanish in a single scandal or collapse. It dissolved slowly, politely, inside a system designed to look stable even as it rearranged who would carry the weight. This story is not about fraud in a dark alley. It's about perfectly legal decisions made under fluorescent lights. About balance sheets that learn to whisper instead of scream. California's financial system didn't fail, it functioned exactly as designed, shifting pressure away from institutions and toward time, complexity, and people who wouldn't notice until years later. The disappearance wasn't an event. It was a process. Ordinary citizens felt it as higher rents and thinner services, though no single line item could explain why. Investors saw something else, opportunity wrapped in municipal bonds and risk priced just low enough to ignore. Government spoke in reassurances, using words like temporary and structural adjustment. And somewhere above them all, the anonymous high priests, the markets and central banks, watched in silence, letting the numbers breathe just enough to survive. This is a story about invisible scaffolding. About how a modern economy can lose billions without ever admitting loss. About why the battlefield moved from courtrooms to spreadsheets, from streets to ledgers dusted by time. If you seek to understand the mechanics of power, subscribe. And tell us, which corner of the global map are you watching from? In the 1980s, California's financial machinery looked like any other state's, orderly, predictable, and comfortably growing. The ledgers gleamed under the cold glow of fluorescent office lights, each entry a promise, each column a reassurance. Yet beneath the ink and paper, a subtle shift had begun. Local governments, in a quiet act of arithmetic innovation, discovered a loophole in timing. Expenses could be delayed, debts deferred, and promises stacked like bricks in a wall no one would inspect for decades. At first, it was almost invisible. A school district would carry bonds longer than they were supposed to, municipality would borrow against projected revenue that might never arrive. Individually, these decisions made sense, they were prudent, even necessary. Collectively, they became a creeping paradox. The state appeared balanced while quietly amassing phantom obligations. Taxpayers felt a weight they couldn't name, a debt born in a boardroom decades before they were born. Investors, meanwhile, saw steady returns, blind to the undercurrent that would one day ripple through the system. The irony was systemic. California's financial system was designed to be transparent, yet it had become an architecture of concealment. The balance sheet was no longer a reflection of reality. It had learned to lie in plain sight, whispering reassurances while quietly reshaping the rules. Each deferred payment, each creative accounting maneuver, was a brick in a wall that only the most patient would ever notice. And then the first tremor arrived, not as a headline, not as a scandal, but as a curiosity. The state's rainy day fund wasn't enough to cover a single quarter of sudden emergencies. By the late 1990s, the problem had compounded. California's financial DNA, once a mosaic of civic optimism, had become a network of interlocking illusions. Bonds issued to fund roads, bridges, and public hospitals were now entangled in a web of derivative obligations, collateral swaps, and interest rate hedges that even seasoned accountants struggled to decode. The rules of the game had quietly shifted. Money was no longer a measure of value, it was a tool to buy time. Government spoke of fiscal prudence in public addresses, yet the corridors of power buzzed with a different language. Every new obligation was a puzzle piece in a ledger only the high priests of finance could read. Ordinary citizens noticed only the consequences: libraries closed early, teacher salaries stagnated, and social programs folded like origami. Investors, sensing opportunity, bought the state's promises at slight discounts, confident that risk had been engineered out. And somewhere above them, central banks and institutional overseers observed with detached interest, aware that the system would self-correct, or implode, without their fingerprints on the collapse. The systemic irony deepened. California's financial architecture, intended to protect wealth, had inverted. The more the system appeared stable, the more money had quietly left the visible economy. The ledger had become a phantom, a mirror reflecting a state of prosperity that existed only on paper. And yet, the process was unstoppable. Every creative accounting maneuver nudged the state closer to an invisible cliff, a moment where the truth of those missing billions would ripple through every corner of society. By the early 2000s, California's financial system had taken on a rhythm all its own. Like a shark that must keep moving to survive, the state's economy relied on constant circulation, new debt replaced old debt, bond sales funded previous obligations, and short-term solutions masked long-term instability. To the outside world, everything appeared calm. Municipal bonds still carried AAA ratings. Pension funds still promised gold-lined retirements. But beneath the surface, water churned with invisible currents. Every failed projection, every deferred payment, became a small tremor echoing through the system. Ordinary citizens began noticing subtle strains, a delayed infrastructure project here, a tuition hike there, a sense that resources never quite stretched far enough. Investors, sensing opportunity in these tremors, moved with precision, exploiting gaps and exploiting timing with surgical accuracy. Governments reassured the public with platitudes, while internal memos whispered truths too inconvenient for press releases. California was balancing not on real wealth, but on a network of anticipatory moves that could collapse at the slightest misstep. The paradox was clear: the system looked stable because it could not stop. Each transaction, each swap, each refinancing became a heartbeat. The state had become a living ledger, but one that would eventually reveal that $92 billion were quietly siphoned into the shadows, trapped between accounting maneuvers and delayed obligations. And then came the signal that no one could ignore: a major municipal bonds rating faltered, hinting at the invisible cracks beneath the shiny surface. As the first cracks appeared, global reactions began to intensify. Investors murmured, algorithms flickered on trading floors bathed in cold blue light, and governments issued reassurances that sounded hollow even as they were written. Ordinary Californians felt anxiety they could not name, a tax here, a fee there, but could not trace it back to the invisible ledger reshaping their lives. Central banks watched silently, the anonymous high priests of finance, knowing that if the rhythm stopped, the consequences would cascade beyond state lines. The irony reached its peak: every public affirmation of stability concealed an accelerating spiral. Money had become a mirror, reflecting confidence while siphoning substance. Bonds were sold to pay bonds, pension obligations were hedged with borrowed futures, and the promise of solvency was more fiction than fact. Each actor, citizen, investor, government, market, was both participant and victim of a system that refused to rest. California's financial ecosystem was a carefully orchestrated illusion, where visibility meant nothing, and ignorance was currency. And yet, the stakes had grown incomprehensibly large. $92 billion had moved somewhere outside of observation, beyond direct accountability, waiting for a moment to announce its absence to the world. The tension between appearance and reality became palpable, like a fog rolling over a golden bay at dawn. The first ripple of realization was quiet, almost imperceptible. Ordinary Californians noticed subtle pressures: fees creeping higher, services thinning, and promises once guaranteed slowly losing shape. Pensioners confronted a fragile security, their futures framed in cautious language and conditional assurances. Investors, sensing opportunity in uncertainty, adjusted portfolios in near-silent maneuvers, capitalizing on what the public could not see. Governments delivered measured statements, designed to calm without revealing the extent of the unraveling. Above them all, the high priests of finance, central banks and institutional overseers, observed with detached patience, understanding that the system itself would eventually narrate the story of what had shifted. Beneath the surface, the missing billions had not vanished, they had migrated. Deferred obligations, creative accounting, and layered financial instruments acted as invisible channels, transferring wealth from the visible economy into abstracted domains. Ordinary citizens bore the consequences without ever touching the mechanism. Investors and governments operated as both participants and witnesses, navigating a system that demanded constant motion. The high priests maintained their silence, guardians of an architecture designed to obscure, transferring power quietly, deliberately, and invisibly. The irony was stark. The very system built to protect trust and ensure stability had created a hierarchy invisible to the public eye. Those least fluent in its language carried the cost, while those who understood the ledger inherited both advantage and foresight. California's financial DNA had quietly rewritten itself over decades, layering abstraction upon abstraction, and the state's citizens only began to perceive the weight when the structure could no longer disguise its seams. When the system's rhythm began to falter, the consequences multiplied. Municipal bonds, pensions, and deferred obligations collided in a hidden crescendo. Citizens felt their lives subtly reshaped, classroom closures, tax adjustments, and social programs thinned as the invisible transfer of wealth moved steadily upward. Investors adapted, shifting their positions almost instinctively, converting instability into opportunity. Governments spoke in cautious platitudes, knowing that revealing the full scope could trigger panic. And in the shadows, the high priests, central banks and markets, monitored the flow, their influence shaping the system's invisible equilibrium. The ledger's truth was both elegant and brutal. Every financial maneuver, every swap, every deferred payment acted as a silent conveyor belt of wealth, moving resources from structures exposed to public scrutiny into opaque, abstract layers. The ordinary citizen's burden grew while those fluent in the language of finance gained foresight and control. The high priest's silence was a deliberate instrument, not negligence. They were the custodians of the invisible scaffolding that dictated who would inherit opportunity and who would inherit uncertainty. The systemic irony was now complete. Stability was an illusion, but it was profitable for those who could read its code. The final realization settled like dust over a forgotten ledger. California's missing $92 billion was not theft or error, it was a consequence of the logic embedded in modern finance. The balance sheet, once a symbol of prosperity, had become a monument to both ingenuity and vulnerability. And as the state emerged into the aftermath, one truth lingered: money is not just currency, it is architecture, trust, and power, layered invisibly, unevenly, and silently inherited. In this quiet inheritance, the world understood that the system never forgets, but it chooses who it remembers. The story of California's missing $92 billion is not just a ledger or a line of numbers. It is a mirror, reflecting the invisible architecture of modern finance in every corner of our lives. The systems that shape wealth also shape opportunity, trust, and expectation, silently deciding who carries weight and who inherits advantage. Every transaction, every deferred promise, every unseen shift echoes far beyond the walls of government offices or trading floors. As the sun sets over the Golden State, the lesson is simple but profound: money is alive in motion, power is embedded in structure, and stability is often only as visible as the eye can perceive. The citizens, the investors, the policymakers, and the high priests of finance all play their part in a rhythm that is older, quieter, and more patient than we imagine. And for each of us, the question remains: how closely are we watching the scaffolding beneath the surface? Because the heartbeat of capitalism touches everyone, whether we notice it or not.